Hi everyone, hope you guys are all doing well. This will be the fourth and final part for the beginner series of options. We have already covered some good content on buying calls, buying puts, and selling puts. Today's topic will be on selling calls. I will teach the basic knowledge you need to know, the risks, and as usual, on top of purely concepts, I will also share some valuable and practical perspectives to the topic. Okay, let's start. And also bear in mind that you are viewing this from the perspective of an options seller now. Disclaimer in a nutshell, this is not day trading or forex. Investing or trading they are all not risk-free instruments, as with anything we do, and this is strictly for educational purposes only. Contents today as shown, I will go through the basics of what is a call option from the perspective of the seller. Recall that as an option seller, you're also known as an option rider. It's just another term we use to describe sellers. I will show you the basic nomenclature table for your own reference. Then I'll review the key advantages and disadvantages of riding a call option. So pay closer attention to this section because selling naked calls is something that I'm not a big fan of, and for a good reason. That being said, it's still important to understand what selling a call means fundamentally because you go on to pair it with other strategies in future. This knowledge will come in handy. Next, I will speak around very quickly how I profit off selling call options. I mainly do covered calls, and I'll explain why. I will also share about how I lost a good chunk of profits before from selling naked calls. Finally, as usual, I'll pull out the Thinkorswim option chain to show you how exactly to execute the sell call option. Nomenclature. So these are just the basics nomenclature used in the option world. So for a start, just refer back to this table for a quick understanding. Okay, next. So the first question to ask is, what does it mean to sell a call option? So when you sell a call option, you have the obligation to sell away 100 shares of a stock at a fixed price upon expiration. This pre-agreed price is also known as what we call the strike price. Each option contract is always measured in denominations of 100, and for this obligation to sell this stock at this fixed price for a set period of time, you receive a premium. So the next thing that I get a lot is, this common question being asked very often is, can I sell a call option if I don't even own 100 shares? How is that even possible? The answer is yes. You can sell a call option even if you do not physically own 100 shares. This is known as selling a naked call. If at expiry, the stock price is against you, you're simply forced to purchase 100 shares from the broker at a higher price and immediately sell it away at a lower price to the person who exercised your call option. Okay, so the next thing you need to know is when you sell a call option, you are bearish in general. Being bearish means you expect the stock to drop lower than the price it is currently trading at. To help you understand why selling call options means that you are bearish, we will go through an example. Alright, so let's talk around the company American Airlines, ticker symbol AAL. Say the stock is trading now at $20 and you are bearish and you think that this stock will not go above $25. You sell a call option with a strike price of $25 with a premium of $3, right, with 2 months to expiration. Since each option contract is in 100 shares, you receive $3 multiplied by $100, which works out to be $300 of premiums. And that is $300 US dollars credited into your account immediately. So what this means is now you have the obligation to sell 100 shares of American Airlines at $25 at the end of 2 months. Now, two scenarios can play out. So scenario number one, if American Airlines continues to drop or remain below $25 after 2 months, your option will simply expire worthless and you will earn the full $300 of premium. Not bad, 300 USD in a month from just one trade. In 2 months, for one trade. Now the logic behind is this: even though you're obliged to sell the stocks at $25, if American Airlines is trading below $25, let's say $22, the person buying the shares would much rather buy from the market at $22 than to buy it from you at $25, right? However, since you took on some amount of risk previously and uncertainty 2 months prior, you are rewarded with a $300 USD of premiums. Hope this is clear. Now, scenario number two is if American Airlines goes above your strike price of $25, right? Say it went from $20 to $40, you are still obliged to sell it away at $25 at expiry, despite being able to sell it to the market at $40 if you didn't sell a call option. So no one can predict what will actually happen to the stock market, and in this scenario number 2, you will lose money. Why? Because let me run you through the math. The stock is trading at $40 now, but you're obliged to sell it away at $25 to someone else instead of selling it directly back to the market. If you do not own 100 shares of the stock, the broker will force you to buy 100 shares at $40 and then sell it away at $25 to the market. However, recall that you receive a $3 premiums per share, right? Therefore, your total loss per contract will be $45 minus away $25, and you add back $3 of premiums, right? So in actual fact, you actually lose $12 per share, and since each contract is 100 shares, you incur an unrealized loss of you incur a loss of $1,200 at the end of 2 months. Well, if you already own 100 shares of the stock, you are just simply forced to sell them away at $25 each. And this case, I will talk more on that later. So to summarize, because if the stock goes lower than your strike price, your sell call will expire worthless and you will earn the premiums, which is good. And therefore, you profit from selling a call when the stock is performing in a bearish manner, because the chances of it hitting your strike price is lower, and the person who bought the call option from you would much rather buy his or her shares from the market at a lower price than to buy it from you. Right? So very good. Let us move on to the next section. We will discuss on the advantages and disadvantages. So first, the advantages. As an option seller, as usual, the money is credited to your account the moment the trade is executed. And from a mathematical perspective, you have a 75% probability of making money, right? Similar to selling a put option. Why? You see, the stock price can move in 4 ways. It can go up, down, stay the same, or be rangy. Being rangy means it goes up and down but stays within a price channel. Let's take the previous American Airlines example to explain. Recall, you sold a $25 strike price call option when American Airlines was trading at $20. So there's 4 ways this can turn out. American Airlines can go down, it can stay the same, or it can stay rangy. For these 3 scenarios, all 3 scenarios, our option will expire worthless, right? And in the last scenario, if American Airlines goes above $25, that is when we start to lose money. So you can see that 3 out of 4 of the scenarios we make money, and we only lose money in the last scenario. This brings me to my second point. As a call option seller, you allow yourself the opportunity to sell away a stock at a certain price and receive premiums for it. However, this concept only makes sense if you bought the stock at a lower price than your call option strike price. Here's where I jump in to value add a little bit. A common strategy which is very low risk is selling covered calls. Selling covered calls means that you actually own 100 shares of a stock when you sell a call on it. The reason why this makes sense and is a very simple but safe strategy is, let's say you bought the stock at $50, you can sell a covered call at $55 and receive a $200 premium for it. If the stock goes down and the call expires worthless, you simply make $200 for that month. If the stock goes up significantly, you'll be just forced to sell away your shares at $55, bearing in mind that you only bought them at $50. On top of that, you still received $200 premiums for it. You literally will not lose money in this type of situation, and the only thing to consider is if the stock goes up to $100, right? Because you could have made more profit selling it to the market. But this is also the opportunity cost that you need to consider. But if you ask me, it's a worthy trade-off, because who doesn't like a trade which guarantees them that they won't lose money, right, when executed correctly? After some years of experience, you will develop a skill set to be able to spot some good opportunities to perform high probability winning covered call trades. For example, in just 2021 and February to March period, the stock market dipped, and I picked up some shares of stocks at lower cost basis, and I just simply sold covered calls on them. It's a very good way to make a couple $100 a month with literally zero risk. Although it is quite capital intensive, so you do need to save up for it. The last point is similar to selling put options, right? Or selling options in general. Time decay works in your favor, and every day the value of your call option contract decays, and all you really need to do is to be passive and literally do nothing but wait. All right, let's move on to the disadvantages. If you have followed me for a while, you'll realize that I'm not a big fan of selling naked call options. I seldom or never do them in a single leg. It is always paired with another option leg like a spread or a strangle. There's a good reason for this, which ties in with the disadvantages which I'm about to share with you. Technically, when you sell call options, your downside is seen as unlimited. Because the stock has a chance to go to infinity, right? And historically, the stock market has been on an uptrend. When you sell naked call options, you're essentially betting against that. From my many years of option trading, the biggest losses has always been from selling naked calls. The higher the stock goes, the bigger your losses will be. For this reason, I avoid selling naked calls as much as possible, unlike selling naked put options, right? Because for selling naked calls, there are literally no filters to be added at all to mitigate the risk. It's like shorting 100 shares of GameStop, right, at $50 only to see the stock skyrocket to above $200. Good luck with that, because all it takes is just one bad day to blow up your whole account. That isn't very ideal, if you ask me. The second point that I want to make is, if you know, when you sell call options, you require a certain amount of option buying power. Let's say for my trades, I typically do 1.5 to 2.5 thousand of buying power per contract. So when you sell call options and the stock goes against you, your buying power requirement will increase, right? Due to volatility and etc. So if it increases to say 4,000 and your account is too small, you might be forced to exit the position prematurely, right? At a loss, or liquidate your existing positions. In this scenario, people with bigger accounts have the advantage because their accounts will be able to weather through bad times first and still maintain the position due to their large option buying power. And eventually, if the stock recovers, they will earn the profit. Whereas for you, you're forced to exit. There's more room for fluctuations for bigger accounts. That being said, this is also the reason why I never understood how and why someone can claim you can start trading options with just $800 or $200 or $300, right? You're gonna get margin caught easily. It just does not make sense. Okay, this is also the reason why I always teach you guys to ideally have 50% of margin buffer and break down the math for you so that you are never over leveraged. Just head on to the group chat to find that Excel file and the video which I shared. Right, I think I done it somewhere in January or in this year or December 2020. So check it out. You need to learn this properly. Simply going in blindly, just selling contracts without being aware of your current account status will only lead to a less than ideal outcome for a winning trade. Next, profit potential for selling calls are capped at the premiums you receive. Say you sold a call option and you received $300 for it for that month. When the option expires worthless, the maximum that you make is capped at $300. No matter how low the stock goes, your profits are capped. Well, I view this, more as a limitation rather than a disadvantage. Yeah, but it's something that it's good to know. All right, so head on to the next section. How I profit from my sell calls. Further to my previous slides, I did mention that I mostly sell covered calls, and the reason is simple. When I buy a stock at a lower price and I sell a call and get paid to sell it away at a higher price, it is a win-win situation, right? It's also worth to mention that experience comes into play here. Alright, so let me run you through this. If you refer to the left side of the slide, here's the not so sensible thing to do. You can't buy 100 shares of stocks during a market all-time high and sell covered calls hoping that you make huge profits. Why? Because when you sold the calls and the market dropped, yes, you earn the premiums. However, bear in mind that you're also experiencing an unrealized loss in stocks if the market drops, right? Especially during an all-time high. When you buy shares during all-time highs, the chances of it dropping lower is higher compared to when you buy it at all-time lows or at lower price basis. So for example, you bought 100 shares of a stock when it hit all-time highs at $100. You sold a covered call at $110 and you received a $300 premium for it. 1 month later, the stock, let's say, drops to $80 and you made $300 of premiums because your contract expired worthless. But don't forget, you're down $20 per share on the stock in unrealized losses. So your total loss for that month will be an unrealized loss of $20, right? Which is offsetted to $17 because you received $3 per share due to the sell call option. But overall, it's still an unrealized loss. Therefore, after some years in the market, you will eventually understand that a market dip is the best opportunity to pick up shares for cheaper, for great companies, and sell covered calls on them. The chances of them recovering up is greater than if you were to blindly jump in and buy them during all-time highs. The next not sensible thing to do is not save up every month and few months and not be ready to buy shares when opportunity presents itself, right? Because even if you choose not to do covered calls, maintaining this discipline will still benefit you, because as you save up slowly, you build your capital. You want to be ready to buy shares for cheaper and strike when the iron is hot, regardless of whether you do covered calls eventually or not. Okay, so let's move on to the sensible thing to do, right? The sensible thing to do is to wait patiently for the right time. And these moments are rare and they only appear ever so often, so make sure you are partially or fully ready for them. Okay, so when the opportunity comes and let's say the stock market drops, here are some good telltale signs. A big drop in a stock price due to reasons which has nothing to do with the business fundamentals. Okay, like a bad news or scandals. You can Google these examples which I provided and highlighted here. I've personally seen these events unfolding and happening in real time. And these are the key learning lessons that I'm sharing with you guys. Okay, all this that has happened has nothing to do with the stock price. In fact, if I recall correctly, Starbucks had a very good financial quarter that year, even though there was some CEO scandal and which caused the stock market to fall, right? And eventually Starbucks just recovered. So you just want to ride the bull run from if you adopt a long-term perspective. Next, any macroeconomic factors, for example, what is happening now with the yield rates, right, which again has nothing to do with business fundamentals, but more towards business valuation of a company, right, which is valid. So what you want to do is, once valuations seem more reasonable, right, and the stock prices has dropped to a level that is currently not absurd, it is a good time to jump in and grab those shares. I hope you guys have benefited from this video. It's pretty straightforward, and I've tried to cover as many things as much as possible. I think moving on, I will just go on to the bonus content and I'll show you how to execute a sell call option trade. Welcome back. So this is the Thinkorswim platform interface. First thing you want to do is head on to the top left hand corner, click on the trade tab, and then enter the ticker symbol of the stock which you want to sell a call option on. Then head on to the option chain and open it up. Let's say I want to do a 3 weeks option expiry. First thing you want to take note is calls are on the left and puts on the right. And when you sell options, you always look at the bid price. And when you buy options, you look at the ask price. So for this case, let's look at the bid price. Let's say I have 500 shares of NEO, which I bought at around $30 cost basis. Right now I can sell let's say a 46 strike price call option, which expires in 3 weeks, right? Just left click on the bid price and change the number of contracts. Always remember that when you sell options, you always have a negative number, and it's always highlighted in red, whereas if you buy, it's always in green and it's a positive number. So let's say I'm selling 4 contracts, check the expiry date and the strike price. Always choose the mid price as well, because when you sell options you want to receive more, right? I much rather receive $206 per contract versus $201 simply by just knowing what to click. Head on to the bottom right, confirm and send. Then you have this order confirmation dialog. For this case, you can just check all the information here, and for this case my buying power effect is 0 because it's a covered call. I actually own the shares, therefore buying power effect is 0. However, if you're doing a naked sell call option, per contract you should expect to see about $1.5 to $2,000 of buying power needed. So that's that, and then all you have to do is head on to the bottom right and click send. So that is all for this tutorial, and I hope that you have benefited greatly from it.